Well, the major averages wrapped up a strong quarter of gains yesterday. S&P and NASDAQ both up double digits, with tech leading the way in the S&P 500. But not all areas of this market had a great quarter. The S&P Value ETF up less than 3%, while the growth stocks rallied more than 18%. So will the trend last? Let's ask Bespoke Investment Group co-founder Paul Hickey and HSBC Global Private Banking and Wealth Management CIO Jose Rasco. Guys, welcome. Jose, I actually, though, want to start with the market impact, for better or worse, of that horse trading going on in Washington right now. I know the tax cut extensions seen as a benefit, but there are also some questions about, I guess, how investors should look at deficit impacts. What between yields and stocks, what do you expect? Where do you expect this to shake out?
Well, we expect to see more volatility in fixed income. Even once they get the bill passed, whatever that looks like, we expect to see volatility in fixed income. That's going to bleed over into the equity markets. It's done that in the last 2 years. But I think, importantly, in terms of taxes, what does that mean? It means that the consumer is going to be healthier than we otherwise thought. And remember, if you look at the CBO estimates, and I looked at the ones from early June, they specifically state that they're looking at these deficit estimates. It's just it's revenues subtracted from expenditures. They're not looking at the second-order effects that lower taxes could have on the economy and positive momentum for earnings. So that has to be factored in at some point as well, from our perspective.
Paul, this was probably the craziest market quarter I can remember seeing, ex-COVID, March 2020, just the drama involved in it. What's the lesson for investors here, especially as we look ahead to the second half of the year?
Yes, I mean, the only parallels of this type of, sell-off and snapback are, like you said, John, COVID in 2020, and then, you go back to 98. Those are the recent examples. And when you look at those periods, when you see, and even further periods in the past, when you see these sharp drops and a quick rebound like you do, it's the market realizing that whatever caused the panic was over, it was an overreaction, and investors were quick to come back in and bring things back to where they were. And what we've seen following those periods is they tended to be more the beginning of a rally than the end of the rally. And so I think, as we may see volatility, as Jose was saying, in the second half, but I think it will pale in comparison to what we saw, like you were just talking about, in the second quarter. So in that respect, it's good. And for the worries about deficits in this bill, I mean, I think you just have to look at the 10-year yield at 4.25, and the market doesn't seem too worried about it.
Jose, I want to go back to this idea of second-order effects and what that means for positive momentum here, because we did see the Dow Transports rally 2.8% today. At least one Wall Street analyst pointed to one big, beautiful bill as the catalyst for that move because of the impact it may have positively on the economy and on the freight market specifically. So if you think that this bill, and I realize the details still need to be worked out here, not to mention the timing, but if you think this bill is going to happen, then how do you invest to capture those second-order effects?
Well, see, the second-order effects, it's not just the bill from my perspective, it's tariffs. Tariffs are not going to be what we saw on Liberation Day, Morgan. And remember what the market did to earnings this year. We took it from 13, 14 to 9%. There's going to be upward revisions once that gets settled from my perspective. Second is the bill, and you have to look at industrials. We like industrials because we're going to see the demand for AI, technology, energy. That is going to be built out by the industrial sector, so we think that makes a heck of a lot of sense. And then you've got the third leg, which is deregulation. And if they deregulate financials, there's more money to lend. Financials are very healthy, especially large cap banks, right? And last but not least is deregulating energy. And if we can do that, retail gasoline prices are about to go to their lowest level in years. That is all positive for the economy, and it is positive for stocks. I agree with Paul. I think you're looking at some volatility here short term, but once these things get resolved and once the Fed gets back in gear, there's a lot of upside here. And if you look at valuation, we usually see on average in valuation cycles a 10x multiple expansion. We've only seen less than 5. We have more upside there as well.